Gone are the days when Singaporeans queued up for discounted Singtel shares from the government. Fast forward to today, Singtel has surged over 80% in 2 years, hitting for Singapore dollars and 9 cents per share. But is this rally justified, or is it time to lock in gains? In this video, we break down Singtel's business model, financial health, market share, analyst forecasts, and more, so you can decide if it's still worth buying in 2025. Quick disclaimer, this video is for educational purposes only and not financial advice. Please do your own due diligence or speak to a licensed advisor before investing. Singtel, or Singapore Telecommunications Limited, isn't just a local telco. It's the largest telecommunications group in Southeast Asia, commanding a market capitalization of 67.5 billion Singapore dollars. It holds full ownership of Optus, Australia's second-largest telecom operator, and strategic equity stakes in some of Asia's telecom titans. 29.5% of Bharti Airtel, India's number 2 mobile provider with nearly 400 million users. 35% of Telkomsel, Indonesia's market leader with over 159 million subscribers. 23% of AIS, the largest telco in Thailand with close to 45 million users. Back home in Singapore, it dominates mobile, broadband, and pay TV markets, but that's just part of the story. Singtel is rapidly transforming into a digital infrastructure powerhouse, investing heavily in enterprise ICT and cybersecurity solutions, Nxera-branded data centers across the region, cutting-edge infrastructure to support 5G and AI-driven applications in Asia-Pacific. In short, this is no longer just a phone company. It's becoming a full-fledged tech enabler for the digital economy. Let's break down Singtel's business by revenue contribution, illustrated here in this pie chart. About 35% of revenue comes from Optus in Australia, Singtel's largest single business unit. Group Enterprise, which handles ICT, cybersecurity, and managed services, contributes roughly 22%. The Singapore consumer segment accounts for around 20 to 22%, covering mobile, broadband, and pay TV locally. Finally, about 20% of earnings come from regional associates like Airtel, and Telkomsel, though booked as equity income rather than direct revenue. This diversified portfolio helps buffer against stagnation in Singapore and creates long-term upside through high-growth markets like India, Indonesia, and Thailand. To understand Singtel's regional strength, let's break down its market share across Asia-Pacific. From its home ground in Singapore to stakes in India, Indonesia, Thailand, and full control of Optus in Australia, Singtel's reach extends over 600 million mobile users across the region. Let's take a look at how it stacks up against the competition in each market. In Singapore, Singtel leads with 49% of mobile subscribers. That's around 4.1 million users. StarHub follows with 24%, while M1 holds 27%. Singtel remains the undisputed market leader on home ground. In Australia Down Under, Optus, Singtel's fully owned subsidiary, commands 35 to 38% of the mobile market, trailing Telstra's 43%. Vodafone/TPG lags behind at just 12%. Optus is the strong number 2 in Australia. In India, Singtel holds a 29.5% stake in Bharti Airtel, which serves roughly 390 million users, capturing 34% of India's massive telecom market. It trails Reliance Jio at 41%, but stands far ahead of Vodafone Idea at 17%. In Indonesia, Telkomsel, 35% owned by Singtel, dominates Indonesia's mobile space with commanding 51% share and over 159 million users. That makes it the largest mobile operator in the country by far. In Thailand, Singtel's 23% stake in AIS connects it to roughly 45 to 46 million users. AIS controls 45% of the market, comfortably ahead of TrueMove at 32% and DTAC at 20%. Let's walk through Singtel's latest financial performance over the last 12 months. Operating revenue remained relatively flat at 14.15 billion Singapore dollars, slightly up from the previous year, reflecting a mature core business but stable top line. Operating expenses declined marginally to 10.59 billion Singapore dollars, demonstrating effective cost management amid inflationary pressures and rising energy costs. As a result, operating profit rose to 3.56 billion Singapore dollars, indicating improved operational efficiency. Other income came in at 235 million Singapore dollars, boosted by investment gains and strategic asset monetization. Finally, EBITDA climbed to 3.79 billion Singapore dollars, a slight improvement that underscores Singtel's disciplined approach to cost and capital efficiency. In summary, while Singtel's revenue growth remains muted, the company has proven its ability to extract more value from every dollar earned. With lower operating expenses, stronger profits, and a steady rise in EBITDA, Singtel's latest numbers reflect a telco that's maturing smartly, not just growing for growth's sake, but sharpening its edge through efficiency, asset optimization, and strategic focus. This foundation sets the stage for long-term resilience as Singtel pivots deeper into digital infrastructure and regional opportunities. Let's break down Singtel's financial evolution across the last 3 years. Revenue has been steady, from 14.62 billion Singapore dollars in FY 2023 to 14.15 billion Singapore dollars in the latest trailing 12 months, showing a mature business with minimal top-line volatility. Net profit saw a dip in FY 2024 to 795 million Singapore dollar due to one-offs, but then surged to over 4 billion Singapore dollars in FY 2025. Largely driven by divestment gains. EBITDA improved consistently from 3.6 billion Singapore dollars to 3.79 billion Singapore dollars, reinforcing stronger operational earnings. Profit margin tells the story. After compressing to just 5.6% in FY 2024, it rebounded sharply to 28.4%, thanks again to cost discipline and non-core asset sales. Return on equity, ROE, and EPS followed a similar trend. Weak in FY 2024, but jumped in FY 2025, with EPS quadrupling to 24 cents. Dividend per share also climbed steadily, from 6 cents to 11.9 cents, rewarding shareholders with rising cash flows. The P/E ratio dropped to a more attractive 17.1 times, indicating better value. But remember, that's partially due to temporary earnings boosts. The P/B ratio ticked up from 2.2 to 2.61 times, reflecting a richer market valuation as fundamentals improved. Net asset value per share also grew, pointing to a stronger balance sheet. On the debt side, the debt-to-equity ratio declined from 50.2% to 44.4%, showing better leverage and financial stability. Lastly, cash equivalents rose from 1.04 billion Singapore dollars to 1.33 billion Singapore dollars, giving Singtel more firepower for reinvestment and dividends. All in all, this table highlights a remarkable rebound in FY 2025, but investors should be mindful of the one-off factors driving the surge. Let's zoom out and look at Singtel's 5-year journey from 2020 to 2025. In 2020 to 2022, Singtel's financials were muted. Revenue hovered below 650 million Singapore dollars, and net profit slid to just 101.9 million Singapore dollars in 2022. EBITDA stayed flat around 230 Singapore dollars to 257 million Singapore dollars, while the share price languished around 1 Singapore dollar and 42 cents to 1 Singapore dollar and 61 cents, reflecting investor caution and pandemic-related headwinds. Then came a shift. In 2023, revenue rebounded to nearly 600 million Singapore dollars. Profit jumped to 170 million Singapore dollars, and the share price rose to 1 Singapore dollar and 81 cents. By 2024, the recovery accelerated. Revenue surged past 698 million Singapore dollars. EBITDA crossed 305 million Singapore dollars, and net profit climbed to 224 million Singapore dollars. Singtel's share price shot up to 2 Singapore dollars and 61 cents, boosted by dividends and growing confidence. And in 2025, the real breakout happened. EBITDA hit a new high at 3.79 billion Singapore dollars, and reported net profit spiked to 4.0 billion Singapore dollars. Though investors should note this included substantial one-off divestment gains. The market responded. Singtel's share price crossed 4 Singapore dollars and 10 cents, more than doubling from its pandemic lows. In short, what looked like a slow-growth telco in 2020 evolved into a leaner, more focused regional powerhouse, rewarding patient investors with outsized gains. First, asset monetization continues to unlock hidden value, from tower sales to the rapid expansion of Nxera-branded data centers. The push into digital infrastructure and data centers positions Singtel at the forefront of APAC's digital economy boom. Its investments in AI and 5G rollout across Asia-Pacific are long-term catalysts for future revenue streams. Backed by strong free cash flow, Singtel has room to increase dividends, making it more attractive to income investors. Lastly, its stakes in regional giants like Airtel, Telkomsel, and AIS provide equity income and strategic leverage across fast-growing markets. But there are risks to watch. Currency volatility in key markets like India, Indonesia, and Thailand could erode earnings once converted to SGD. Regulatory hurdles, particularly in Australia and India, continue to pose headwinds to expansion and compliance. Growth in core markets like Singapore and Australia is slowing, putting pressure on organic revenue drivers. Singtel is also dealing with legal challenges, including an ongoing class action lawsuit linked to the Optus data breach, which may result in fines or reputational damage. And finally, while FY 2025 earnings look strong, a big portion came from one-off divestment gains, meaning the EPS boost is not fully sustainable. In short, Singtel's outlook is promising, but success depends on careful execution, regulatory navigation, and delivering on digital transformation. Let's take a look at what analysts are saying about Singtel's stock outlook. DBS Research gives a buy rating with a target price of 4 Singapore dollars and 40 cents, highlighting Singtel's strong leverage across regional markets and the growth potential in its expanding data center business. OCBC Investment also rates it a buy, with a 4 Singapore dollars and 20 cents target, citing dividend appeal and further upside from asset monetization like tower and data infrastructure sales. UOB Kay Hian shares the optimism, setting a target of 4 Singapore dollars and 25 cents, driven by confidence in Nxera's growth and Singtel's pivot toward enterprise and digital services. The average consensus target price is 4 Singapore dollars and 28 cents, which implies around 4.6% upside from its current trading levels, not counting dividends. While the upside may appear modest, remember, most analysts are focusing on long-term structural growth, digital transformation, and stable dividend payouts, a compelling combination for both growth and income investors. Singtel has shifted from a flat-growth telco to a rising digital infrastructure giant in Asia. It dominates mobile markets in Singapore, Australia, and Indonesia, earns strong profits from Airtel and Telkomsel, and is scaling its Nxera data center business. Dividends are rising, backed by solid free cash flow. But FY 2025's record profit includes one-off divestments, not organic growth. Legal headwinds like the Optus data breach and slowing growth in core markets are real risks. Singtel remains a compelling long-term hold for dividend stability and Asian growth. Just be mindful of inflated earnings and premium valuation above 4 Singapore dollars. Like, comment, and subscribe to Durian Finance for more smart investing insights.